I'm going to be interviewing an energy. I'm going to be interviewing an energy modeler from Carbon Tracker about a report that came out on Canadian oil and gas competitiveness into the future. Before I do, though, if you're a regular viewer, you know that I kind of have my hobby is reading energy demand, particularly oil demand modeling. And so I was really excited to do this, but I have a request of you. And that is that we're going to get into some numbers. We're going to get into some of the technical detail behind the numbers, some of the assumptions. This is going to be a little nerdy. So I'm going to ask you to stay right to the end of the half hour, 45 minutes, whatever it takes, because this is important stuff. We've got in just a few days, the federal government is going to likely announce a memorandum of understanding between the government of Canada and Alberta on a pipeline to the West Coast. This is, I mean, all sorts of implications to this. One of them is we're in for a big political fight, and because British Columbia is not happy. So this is important background because you will not find it anywhere else. This is a distinguishing characteristic, a poor one, of our debate over this issue is that nobody talks about the business case, nobody talks about numbers. Well, here at Energy Media, we're going to be talking about numbers. So, Rich, welcome to the interview.
Great to be here.
Now, you're an energy analyst with Carbon Tracker, and you and your colleague Olivia have put together this report on, in this case, we're going to talk about oil demand modeling. Can you give us an overview of your conclusions, sort of based on talking about oil demand and specifically the oil sands? Where are we going with that?
Sure, yeah. So Olivia and I have both worked on two separate reports, looking at the future of Canadian oil and gas and kind of how competitive it is, given the trends that we're seeing in the energy transition. The report that I was lead author on looks at the fiscal side of the coin, and Olivia's looks at the corporate risk. And essentially, what we find is, given Canada's high cost of production for its oil and gas sector, it's really going to struggle to stay competitive globally as the energy transition unfolds. We know that a peak in oil demand is coming. Most say it could be around 2030, but clearly predictions vary. And then gas is not going to be too far behind. And what that means is that prices are going to be depressed. The clean energy is going to continue to cut into that demand. Transport electrification, we know, across many different countries, is accelerating. Sometimes in countries that you might not expect, in emerging economies. There's a lot of noise often around particular countries taking steps back when it comes to the energy transition, but at a global level, the trends are still all pointing in one direction.
Okay.
And so for the
Let's talk about some assumptions here, Rich, because we've done a number of videos, and in fact, for those of you who are interested, I published a Substack essay just last week about this. And here at Energy Media, we have a methodology that's suited to our journalism, because one of the modelers never use one scenario. They always have usually three scenarios, sort of a high case, middle case, and a low case. And what I can't, I'm math challenged. I am not in a position to challenge the math of their analysis. And they all use computer models, and some of them use the same data. But what you can do, and what Energy Media is particularly well suited to do, is to challenge or test their assumptions. Now, so what an assumption is Rich was talking about where the trends are going. So if you're OPEC, do you assume that electric vehicles are going to get cheaper, faster, or cheaper, much slower? Because if you believe that it's going to be faster and global transportation electrifies quickly, well, that makes up 45% of global oil demand. And so therefore, you would see peak oil demand coming very quickly, like 2030, as the International Energy Agency says. If it's slower, then you can argue, as the OPEC does, that the oil demand will continue to grow out to 2050. So these are the assumptions that are baked into each one of these scenarios. And so, as a journalist, I can go out and interview experts and look at data and show where the trends are going and compare the assumptions to the data and the evidence. And that's actually a very, very useful way to go. And our conclusion at the end of that exercise that I published last week was that the International Energy Agency's APS scenario is the most likely based on the trends we see today. And those would be accelerating over time, electrification of transportation being the big one. So here's the thing. That leads us from 103 million barrels a day of demand today to 55 million barrels of demand a day in 2050. It's almost half. And that has big implications for whether or not Canadian oil it remains competitive, especially if we're trying to export it to China and India. Rich, have I described, from your point of view, reasonably well how modeling works and the approach that we take for testing assumptions?
Yeah, I think that's a great overview. From our side, we look at both the supply and the demand side. So for our supply side data, we use modeling from Rystad Energy, which is a well-respected energy consultancy, and then we apply that to demand scenarios from the International Energy Agency. And you mentioned one of them, then the APS scenario, which is the announced pledges scenario. And in the reports that we've published, we look at a range of price scenarios. And essentially estimate what the revenues would be under those pathways. And from the fiscal point of view, we estimate that in the 2030s, which is really when this is going to come to a crunch with that peaking demand, as I mentioned, for the provincial governments. Across those governments, so that's Alberta, Saskatchewan, Newfoundland and Labrador and British Columbia, oil and gas producing provinces, they could see their fiscal revenues from oil and gas fall by over 80% during that decade, and that's partly because of the lower oil price and oil and gas price scenarios, but also lots of projects not going ahead because the industry would just believe that they would view those break evens as just too high and not economically viable. And then for the corporate risk side, it's looking at what value would particular investment strategies really deliver for oil and gas companies and their investors. And we see that there's much bigger downside risk for those companies from the energy transition than potential upside risk under slower paced environments. And so we really just want to warn stakeholders that the energy transition poses significant risk for those investments and for provincial revenues going forward.
Right. And I think it's really important here for our readers because I can see the readers or the viewers saying, well, okay, Markham and Rich, but, if what you're saying is true and there's, a big risk to increasing production going into the 2030s, then why are the Alberta oil companies wanting to expand so rapidly? And why does the Prime Minister Mark Carney, who's got a PhD in economics from Oxford, for crying out loud, why does he want to build a pipeline out to the West Coast, 1 million barrels a day? None of that makes sense. But this is where we have to make this very clear. The Alberta government, the Natural Resources Canada, which is kind of the Canadian Energy Ministry, and the industry itself all are bought into the OPEC view of the future, where we will see demand grow between now and 50 out to 120 million barrels a day. And that lines up also with the IEA's new scenario that it introduced a couple of weeks ago, which is the CPS, the current policies scenario. Okay, so we here believe that the APS scenario best matches the data. the government, the industry, the provincial governments all see it as the OPEC model, the CPS scenario coming true. That explains why they want to expand, and we think that we don't. So let's that assumption out of the way, Rich. Let's now talk about break even, cost break even, production cost break even, and the assumptions behind that. So tell us what data you use and roughly the range for break even per barrel costs in the oil sands.
Yeah, so as I mentioned, we use data from Rystad, which provides break-evens for assets all across the world, so we can kind of compare different countries' costs of production and which assets would really be compatible with different scenarios, which would be competitive and economically viable under different levels of demand, and we do find that the oil sands particularly exposed on that. I don't want to go into specific numbers and kind of fall foul of our license, but essentially, yes, the oil sands do sit very far up the cost curve, particularly for new projects, which would obviously need to would have a significant payback period to kind of recoup that initial capital expenditure. And so really the message for us is provincial governments need to kind of take into account these, in their view, less optimistic scenarios for oil and gas demand, what that would mean for their budgets going forward, and really focus on diversifying their tax base so that they're not so reliant on these oil and gas revenues going forward.
Okay, so we took our data from investor presentations from the third quarter of 2025 of the oil sands companies. Now that Meg Energy is going to be absorbed by Cenovus Energy, that really leaves only four: Cenovus, CNRL, Imperial Oil, and Suncor. Those account for almost all of the bulk of the oil. And I should point out that Canada itself produces 5 million barrels a day of oil. 4 million barrels a day of that comes from Alberta, and of that, about 3.5 million barrels a day comes from the oil sands. And the only fields that are going to be increasing between now and 2030 are the oil sands. That's where the forecast comes from. Conventional oil in Alberta is only 500,000 barrels a day, and it forecast is flat right out to 2050 and beyond. No increase. So the oil sands is where the action is. That's where we're going to focus. So our analysis shows that the break-even cost per barrel in West Texas Intermediate is $42 at the bottom and around 50-ish dollars, maybe low 50s at the top. Now, Rich, without giving away the farm and getting you in trouble with the Rystad folks, your numbers are higher than that, are they not?
In the case of some assets that they will be, and some assets won't be. Really, yeah, it kind of there's a mixed picture across the board. But yes, essentially those assets would struggle in an environment of say a $40 oil price, which is what we've modeled under the APS scenario, and that would clearly cut into revenues for the provincial government significantly. For Alberta, it would actually cut them by 85% during the 2030s, given that some of those projects wouldn't go ahead, and then existing projects would obviously generate far lower royalties and corporate income tax.
Now, here's an important point that we're going to cover in an essay we're publishing today on our Substack, Thoughtful Energy Journalism, if you want to find it, folks. And that is there are two types of costs here. So in the oil sands, they talk about half cycle costs and full cycle costs. So full cycle costs are all the costs associated with getting that oil out of the ground. Your operating capital, your sustaining capital, your upfront capital, your everything. But half cycle costs are only those costs required to keep the lights on and the oil flowing. And those are much, much lower. Those can be down in the range of $20 to $30 a barrel. So the point I want to get at here, Rich, is that the idea of using half cycle costs works for a cyclical downturn. Like if you have 6 months or 12 months, maybe 2 years of low oil prices, like we saw, 2015, 2016, the companies can limp along and basically survive on half cycle costs. And it's very different than that. Conventional companies have a much harder time. They have to shut in production and they take a real, they take their lumps. The oil sands companies are better situated. But what we're talking about, Rich, in the 2030s is structural decline. Now we're talking about demand contracting, and it's not coming back like it does in cyclical times, boom and bust. This time it's going to be bust going forward until the industry sunsets, which could be who knows how long that's going to take. And that is an important distinction, isn't it? That the half cycle costs aren't a significant advantage during structural decline.
Yes, that's right. I mean, clearly it's likely to be a kind of a bumpy ride. It's not going to be a smooth decline. There will be fluctuations in prices. These are, volatile commodity prices as we know. But looking at the demand scenarios that we use from the IEA, the likely prices under those scenarios are averages across that time frame. And yes, the demand is going to be destroyed permanently through the electrification of transport in particular, but obviously lots of other trends going on across the economy.
Agreed. Okay. Now, here's another point that's really important. Inside North America, where the oil is pumped, is transported by pipeline, and pipeline tolls, as they're called, range from $7 to $9 a barrel to get them down to Chicago and Detroit or Houston or Denver or wherever they're going. And so inside North America, the Alberta heavy crude is the most competitive barrel. It's more competitive than Venezuela. It's more competitive than Mexico. And that's why it has 60% of the heavy crude oil market in the United States, which is about 5 million barrels a day of refining capacity. So it can compete in the one market we don't want that we already dominate. But here's the problem. Building a pipeline to serve Asian markets, primarily China and India, now you have pipeline tolls and insurance costs and dockage fees, and you have to put it on a tanker and you have to get it over to those markets. And judging if we use the costs that come from the Trans Mountain Expansion pipeline, which is as close as an approximation as we can get, it's about $16 to $18. So, Rich, my question to you is, as much trouble as these oil sands producers have in their existing market, given your modeling, if you add $18 a barrel of transport costs to get over to China, they go from being they're not a competitive barrel. They're not. There may be a marginal barrel at best, and maybe not even marginal.
Yeah, I mean, absolutely right. Those additional transport costs and pipeline costs are going to just make those barrels just less competitive globally. And even I think in the US, it's important to say, yes, we're going through a kind of political cycle where clearly some of the kind of climate policies and energy transition policies are being stripped back. But industries have to invest for the long term. For something like a pipeline, it's got decades of operational life. So really the question is that demand going to be there in 5, 10, 15 years time to make that decision kind of economically rational, and we would say the trends are clear across the world, with the scale up of clean energy and electrification, and that's likely to take place in the US as well as the rest of the world. But it's clearly just having some bumps along the road at the moment.
Okay, now you mentioned that you had modeled at $30 a barrel, so that's the price. And obviously, given the break evens that we just talked about, that price is significantly lower. It's lower for our numbers. It's very, very low compared to your numbers. But you didn't just model at $30, did you? If I understand you correctly, you modeled at 40 and 50 and 60 and so on. Maybe you could explain that.
Yeah, sure. So for the corporate risk report, we did model at 30, 50, and $70 to kind of give a range of what the revenues and what the value of those investments would be across different scenarios. And we took a similar approach in the fiscal um, fiscal focused report, which particularly derives those from the APS and the STEPS IEA scenarios, and it shows just how much of a difference those two scenarios would make. I mean, clearly we don't know exactly which path the global energy system is going to take. It could be somewhere in between, but we're just really making the point that those revenues are going to take a big hit from a faster paced transition. And I think when you look at scenarios, you mentioned the OPEC scenario, and you look at the track record of a scenario like that, they've clearly consistently overestimated oil and gas demand, and underestimated the pace of the transition, and we think that that's only going to accelerate as we go forward. So it's looking more likely that we'll see a much faster paced transition.
And let's talk about some other modeling that is related to yours, and that comes from the Canadian Energy Regulator and their 2023 Canada Energy Futures Report. So this is the first time that the government actually directed its regulator to go away and model something other than the usual standard scenarios, which we'd had up until that point. And what they found for the oil sands was that once prices get down into the $60 range and lower, but even $60, you're starting to see a reduction in output, in supply. Projects become economic and get shut in, or they're allowed to run out their life and they're not replaced. And the lower the price goes, the worse it gets. So they have on the scenario where they model the APS scenario, the one that we think is most likely, what they see by 2050 is that the oil sands loses at least 30% of its current production. Its levels go down. So if it's at like 3.5, then it would be down by, maybe close to a full million barrels a day. Not growth, not building pipelines all over, east, west, north, and south the way Alberta Premier Danielle Smith wants, but a significant reduction. And that's using this very same scenario that you use, the APS.
Yeah, I mean that's exactly what's reflected in our modeling, that production would decline. It's partly from, as you say, existing assets being shut in, but also expected future assets not going ahead because they wouldn't be approved, and they wouldn't reach final investment decision under a lower price scenario like that. So then really the calculus for a new pipeline, you know, clearly it's hugely undermined by a trend like that.
And I want to point out some other modeling that we've seen, which is from S&P Global. Now, S&P Global is really important because their modeling is done or overseen by an energy economist that I've interviewed him for the last 10 years, and that's Kevin Byrne. And he is the most knowledgeable oil sands economist that I've ever run into. And so when I need really granular, detailed analysis, I turn to Kevin. So the S&P global modeling is that we're going to see growth from now until about mid 2030s. So up from 3.2 is where they started, not 3.5, but 3.2 up to 3.9 million barrels a day. And then it was going to decline to about 3.5 million barrels a day, maybe a little bit lower. So even and I don't think Kevin would be too insulted if I said that they were an industry-friendly consulting firm. They do a lot of this kind of work and for oil companies around the world, and so they are. We're not talking about Greenpeace. These guys are industry friendly, and Kevin knows these cost curves and the various projects in the oil sands backwards and forwards. So that's even the industry friendly modelers are showing that under the anticipated circumstances, not the APS, but more sort of a steps or OPEC scenario, demand still falls significantly between now and the say late 2030, say a decade out. Would you agree with that, Rich?
Yeah, I mean that's very similar to what we see in Rystad's base case scenario for oil production in Canada. It remains there's a very modest increase between now and 2040, but it's largely flat between here and 2040. So then really the question becomes where is that additional demand gonna come from for a pipeline to justify an investment like that.
One of the criticisms I've heard of our take on this is from folks in the industry who say, oh, yeah, you can talk about production or you can talk about break-even costs for companies that are traded on the public stock exchange and have to respond to market economics and pay royalties and so on. But when you look at Middle Eastern producers, and the two big ones in the heavy crude side of things would be the Saudis and the Iraqis. Yeah, sure, they can get it out of the ground for $10, and sure, they can put it on a VLCC tanker for $2 to get it to China and India. But they run very, very generous social programs for their people. And so what they actually need to support the government that they've built is more like 70, 80, $90 a barrel. And so they say, oh, that's the figure you should use for break even. And Rich, my response to that, and I want to see what you think of this, is sure, as in a business as usual scenario, that's a legitimate argument. They need 70, 80, $90 a barrel. But when demand begins to decline and they're fighting for market share, the gloves come off. And the Saudis have showed it as late, just in the last 6 months, actually, that they'll lower the price to take back market share. And they really showed it in late 2014 into 2016, where they just opened the taps and drove the price down and they were going back and they were trying to get market share back. And so my argument would be that once you're into structural decline, then the Middle Eastern producers would adjust their expectations and they would not give up market share in order to demand a higher price just to support their government revenue. Is that a reasonable argument?
Yeah, I think so. I mean, and what you're talking about really is what's known as the fiscal break even for those governments. These are governments that are highly dependent on oil and gas revenues. And we looked at this in a recent report on Petrostates, and we really highlighted the kind of vulnerability of those governments to the energy transition. But I think what you're kind of getting at is that they would be willing to kind of suffer those lower price environments. I think they would probably end up having to cut lots of the social spending to kind of remain competitive and kind of hold on to that market share, because clearly that's such a core part of their economy. They're not going to kind of allow that to be threatened by other producers.
Yeah, I guess the point I'm getting at here is that economists make certain assumptions about price. So at X amount of price, the high cost producers will fall out of the market quickly. It's just like they fold their tent and go, okay, we can't compete. We're now going to shut in our wells and fold our tent and go home. But that's not what happens in the real world. In the real world, the producers come to government and they go, oh, this isn't a structural decline. This is a cyclical decline. We need you to subsidize us with tax breaks and direct subsidies and all sorts of things. Hello, Canada. This is exactly what we're doing now. We're being asked to subsidize carbon capture and storage to the tune of $10 billion. We'll probably wind up having to pay for a new pipeline or a part of it. This classically fits the pattern here. But my point, Rich, is that it doesn't, in the real world, as the market shrinks, the market players become more competitive and they fight and fight and fight to hang on to their market share and they keep the price down. Is that a reasonable way to look at this?
Yeah, I think that's what you're going to see. You're going to see all producers trying to cut their costs to really fight for for a pot, a slice of the shrinking pie. Really, that's what's gonna happen. And clearly, perhaps some producers will be able to cut those costs more effectively, but it is hard to see the very energy intensive oil sands producers being able to cut their costs faster than others to kind of remain competitive at the global level.
So well, I want to finish up the interview this way, Rich, and that is that we acknowledge that modeling is an imperfect science, and no one has a crystal ball. No one knows what the future is going to bring. We have to deal with the data we have in front of us and make reasonable assumptions about it and reasonable calculations. And one of the things that countries that like Canada that are looking at, what's going to happen going forward, is that they should not look at only the most bullish, optimistic demand forecasts, but in order to properly calculate risks, they should also take into account the downside. And this is something we've been saying for a long time. Like, look, this is our argument based on all kinds of data and modeling and, trends and so on. I mean, there's, we in the last half hour-ish, we've talked about a lot of numbers and assumptions. And if you don't agree with it, then bring the counter argument. Do your own modeling, show your own assumptions, show your own math, and then we can compare the two and we can have a realistic talk about risk. But when the government and the industry and the provincial governments are doing as they are now, and it's all driven by narrative, there are no numbers ever mentioned, there is no analysis ever released, none of that, then what happens is you misallocate risk, you misjudge risk, and you expose the country and the taxpayer to the downside, and because you haven't properly assessed it. Is that a reasonable way to look at this?
I think so. Yeah, I think really all stakeholders here, so the provincial government, the federal government, oil and gas companies, investors, they really need to look at a range of plausible scenarios and kind of sensitivity test their forecasts and their assumptions based on those, because otherwise they could well be kind of leading the country down a kind of a blind alley when it comes to the future of oil and gas kind of economics in Canada, and it's just really important to be aware of those risks and to plan accordingly, and not to be kind of over optimistic really about future demand.
A thought occurred to me, and I want to ask you about this because right now in Canada, Prime Minister Mark Carney has very, very high approval rating for a Canadian Prime Minister. We usually eat our children is what we do, or eat our young, and so we don't give our prime ministers very long of a honeymoon. But he's got one because he's a smart guy and he seems to be doing a good job. People want to give him the benefit of the doubt. And I can't tell you how many people have said, well, do you think Carney doesn't know this? Well, you know what? Maybe Carney doesn't know this because we argue here in our energy transition theory of change that roughly 2020 was the inflection point where a lot of these clean energy technologies like EVs and heat pumps and solar panels and batteries and so on became economic. They became competitive in the marketplace. And so we're really only, I would argue that the analysis has really only in the last 2 or 3 years become overwhelmingly clear that inflection point was passed, and now we're into a new part of the energy transition, the hockey stick part of the S curve, where we're rapid growth and things are changing. That's not very long. That's like 2, 3 years, maybe 5 years at the most, is not very long in a big, massive energy system like we've got. And I think it's entirely possible that our decision makers, including our prime minister with his PhD in economics, have not kept up with the data, have not are not reading the latest modeling and the latest evidence and so on. And so that's my hypothesis here for you. What's your take on that, Rich?
Yeah, I think that's very very possible. I think given how fast moving the kind of landscape is, yeah, a lot of well-informed people just may not be staying up to date on the trends. And I think, I mean, I'm not an expert on the Canadian political situation at the moment, but I suppose one other aspect of it is that the government wants to go ahead with some big kind of exciting projects to boost the economy, given the kind of situation with the US tariffs, and some of these projects like the LNG projects and the pipeline just seem like, although those are good infrastructure projects that we want to go ahead with, and we can tell a kind of positive story about those, and it's partly a kind of short term political political strategy, but it's not taking into account the longer term trends that you need to kind of take into account when allocating that level of investment into new projects. That would be yeah, my sort of take on it.
Yeah, you know what? That is the thing is assessing risk because we're not talking, governments have got into projects, invested hundreds of millions of dollars, sometimes billions of dollars. The project fails, you take your lumps like any investor would and you move on. That's one thing. It's quite another when you're talking about very capital intensive infrastructure projects where the Trans Mountain expansion pipeline, which is roughly, well, let's call it 60% of the one that's being proposed, it costs $34 billion. And the government had to pay for every penny of that by backing the debt of the company, right? And so now we're talking about we're going to have to build another pipeline out, to the West Coast. So 35 to $50 billion. Then we're going to talk about decarbonizing the oil sands, which the total cost of that was estimated 4 or 5 years ago at 70 billion. I would argue it's probably closer to double that now. And we're going to be picking up, the industry has said it wants governments to pick up 2/3 of the cost. So there you're anywhere from 50 to $100 billion. And all of the other, there'll be all sorts of infrastructure and other monies that'll have to be paid. So if you don't assess risk properly on these projects, this is the kind of stuff that bankrupts governments and puts people puts the taxpayer in a hole for a very long time. And it's the lemming-like baying of the hounds. I'm sorry for mixing my metaphors, folks, but it's that mindless baying of the hounds. Don't want to listen to anybody else. Blah 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 blah. It's got the ears turned off, and we don't want to assess risk properly. That's what bothers me. Now, are you seeing that in any other jurisdictions? For which you've modeled?
I think nothing. Nothing comes to mind that I've worked on really recently. I mean, yeah, this project on Canada has been the main focus, but I did want to just come back on your point around decarbonizing the kind of oil sands production and oil and gas in general. You're absolutely right to say that would be, it's a hugely expensive undertaking using carbon capture and storage. That could cut some of the operational emissions, but it would come with a very heavy price tag, and that's clearly adding further costs onto onto oil and gas production, making it less competitive with alternatives, and it's only taking into account the operational emissions. So those are really only around 15% of the overall life cycle emissions of oil and gas. So it's really not a kind of get out of jail free card, I suppose, and it's not going to insulate the sector from those declining demand trends, and I think that's possibly not always kind of fully appreciated when discussing these topics.
Rich, thank you very much for this. We're going to have you and your colleague Olivia back to talk about LNG at some point, and there's some other aspects of your modeling report that I'll probably follow up on as well. I mean, it's like Christmas in the Hislop household when we get these kind of reports in the door at Energy Media. So, look, thank you very much for this. Really appreciate it.
It's been a pleasure. Yeah, great to talk.